Welcome to the TaxSlayer Pro Basic Income Tax Preparation course. This is Module 8. We'll cover Income Part 6. This is the final module for income for filing 2018 tax returns. In this module, we'll discuss unemployment compensation, Social Security, other forms of income, and the Foreign Earned Income Exclusion. First, let's look at unemployment compensation. Many Americans are collecting unemployment insurance payments, and some are doing so for the first time ever. Some people are left wondering if unemployment payments are taxable or not. The short answer is yes. Unemployment income is taxable. Since unemployment income is treated as normal income, the amount is indeed taxable. Unemployment compensation is includable in gross income. You must report unemployment compensation on line 19 of the new Schedule 1 for 2018, Form 1040, then on line 6 of the Form 1040 itself. Unemployment compensation generally includes any amounts received under the unemployment compensation laws of the United States or of an individual state. It includes state unemployment insurance benefits and benefits paid to you or the taxpayer by a state or the District of Columbia from the Federal Unemployment Trust Fund. If you or your client received unemployment compensation during the year, you should have received Form 1099-G showing the amount paid. Box 1 shows the total unemployment compensation for this client. Any unemployment compensation received during the year must be included in your income unless you contributed to the fund. Unemployment compensation is reported on Schedule 1, line 19, and then transfers to Form 1040, line 6. So in summary, unemployment is any amount received under an unemployment compensation law of the U.S. or of a state in the U.S. It's reported on Form 1099-G, taxable in most cases, and not considered earned income for the calculation of the Earned Income Tax Credit. Next, let's look at Social Security and Railroad Retirement. Social Security benefits may be non-taxable or partially taxable depending on your total income from other sources. If Social Security is your only source of income, in other words, according to the IRS, if the only income you received during the tax year was your Social Security or equivalent railroad retirement benefits, then your Social Security benefits are probably not taxable and you probably will not have to file a tax return, again, according to the IRS. How much, if any, of your Social Security benefits are taxable depends on your total income and your marital status. If you received income from other sources, your benefits will not be taxed unless your modified adjusted gross income is more than the base amount for your filing status. You can do the following quick computation to determine whether some of your or your client's benefits may be taxable. First, add 1/2 of the total Social Security benefits you received to all your other income, including any tax-exempt interest and other exclusions from income. Then, compare this total to the base amount for the filing status. If the total is more than your base amount, then some of the benefits may be taxable. The 2018 base amounts are $32,000 for married couples filing jointly, $25,000 for single head of household qualifying widow or widower with a dependent child, or married individuals filing separately who did not live with their spouses at any time during the year, and $0 for married persons filing separately who lived together during the year. Social Security benefits are reported on Form SSA 1099. Here's an example. You and your wife are filing a married filing joint tax return for 2018. You both received Social Security benefits during the tax year. You received a Form SSA 1099 showing benefits of $7,500 in Box 5, and your wife received a Form SSA 1099 showing benefits of $3,500 in Box 5 of her form. Your total combined W-2 wages for the year turned out to be $22,500. How much of your Social Security benefits are taxable? Well, let's find out. Again, here's Worksheet A, a quick way to check to see if your benefits may be taxable. We entered the amount from Box 5 of all forms SSA 1099, in this case $11,000. One half of the amount on line A, $5,500. The taxable wages were $22,500, so the total on line E, $28,000. The base amount for 2018 is $32,000 for married couples filing jointly. Therefore, none of the Social Security benefits are taxable in this case. Assume the same scenario as previously described, except the combined wages for the couple are $45,600. So how much of the Social Security benefits are taxable in this case? Again, total amount of Social Security benefits on line A, $11,000. One half of line A, $5,500. The total income we said was $45,600. We add all that together, and on line E, $51,100. We enter this into the Social Security benefits worksheet, and after doing the math, we see on line 18, taxable Social Security benefits in this case equal $93.50. The total benefits are reported on line 5A of the 2018 1040, and the taxable amount is reported on line 5B. So in summary, determine if Social Security or railroad retirement benefits are taxable. If Social Security is the only source of income, benefits are generally not taxable. If other income present on the return, complete the Social Security benefits worksheet in order to calculate the taxable portion of the benefits. Next, let's look at other income. We use line 21 of the new 2018 Schedule 1 for the 1040 form to report income that's not reported on any other line. In general, you shouldn't use line 21 to report income reported on a 1099 miscellaneous form. Generally, this income is reported on Schedule C. Don't use line 21 to report non-taxable income such as child support, Roth IRA distributions, gifts received, or inheritances. Some examples of amounts that need to be reported on Schedule 1, line 21 include gambling winnings, prizes and awards, fees for jury duty, fees for being an executor, administrator, or personal representative of an estate, and canceled debts. Income from an activity not engaged in for profit, such as a hobby. And now the Foreign Earned Income Exclusion. This allows qualified taxpayers to voluntarily exclude foreign earnings from taxable income. It does not apply to members of the armed forces or U.S. government employees. Taxpayers cannot claim the Earned Income Credit or Foreign Tax Credit if using this exclusion. And the term foreign country does not include U.S. territories or possessions. and it's claimed, the Foreign Earned Income Exclusion is claimed using Form 2555 or 2555EZ. And here's an example of Form 2555, the Foreign Earned Income Exclusion form. And you may be thinking, wait a minute, I thought we were talking about income, not exclusions. Well, if we look down here on line 45, we're told to enter the result here and in parentheses on Schedule 1, Form 1040, line 21. And next to that amount, enter Form 2555. We subtract this amount from additional income to arrive at the amount reported on Schedule 1. So here on Schedule 1, we report our Foreign Earned Income Exclusion and a supporting statement. And to be eligible, the taxpayer must demonstrate that his or her tax home is in a foreign country. To get the Foreign Earned Income Exclusion, the taxpayer must meet a period of stay requirement, either the bona fide residence test or the physical presence test. And to get the Foreign Earned Income Exclusion, the taxpayer must have income that qualifies as foreign earned income. For married couples, the requirements must be met separately for each person. And for taxpayers whose regular place of abode is in the United States, it cannot be considered to have a foreign tax home and would not qualify for the exclusion. Again, taxpayers whose regular place of abode is in the U.S. cannot be considered to have a foreign tax home and would not qualify for the Foreign Earned Income Exclusion. So what's required to meet the period of stay condition? The bona fide residence test goes like this. The taxpayer must have set up permanent quarters in a foreign country for an entire uninterrupted tax year. The physical presence test means that taxpayers must be physically present in a foreign country 330 full days in 12 consecutive months. So in summary, Schedule 1, line 21, Other Income, includes any taxable income for which there's not a specific line identified. U.S. citizens are taxed on worldwide income and must file a U.S. tax return even if all the income is from foreign sources and even if they paid or will pay taxes to another country. If the taxpayer is eligible to exclude some or all of foreign earned income, we complete Forms 2555 or 2555EZ. The excludable amount will be entered as a negative number on Schedule 1, line 21. And now, let's look at a few review questions.